Investment advisory services offered through AlphaStar Capital Management, LLC, a SEC-registered investment advisor. AlphaStar Capital Management, LLC, and SWAN-Capital are independent entities.
What your money would say. Andrew McNair. Money Talks. Are you listening? Money Talks. Are you listening? Money Talks. Are you listening? What your money would say with Andrew McNair.
We're live here on What Your Money Would Say. I'm your host, Andrew McNair, and for the next 30 minutes every Saturday from 12:30 to 1 o'clock here on WCOA 1370, we will be your retirement resource. Now, I'm excited about today's topic because I always love to get into those really controversial topics. And the topic we're going to talk about is reverse mortgages. But before I do that, I want to share with you some upcoming events we have here at SWAN-Capital and remind you that this show is live and that the lines are open. And you can give us a call with your retirement or estate planning questions anytime live on the show. And that phone number, if you're driving, you want to grab a pen and paper, it's 478-3116. That's 478-3116, and we'll answer your question live here on the show. Now, the upcoming event I want to highlight here at SWAN-Capital is our Social Security Benefits Class 101 that we have at UWF. And it's going to be October 8th and October 10th. And what we're going to do is we're going to peel back the onion on Social Security benefits. We're going to talk about the birth and design of Social Security and the future and how the birth impacts the future of Social Security. Is it going to be there for you? We're going to talk about when to take it, 62, 66, or 70. And finally, how do you maximize those benefits? Because they're so crucial in retirement. Remember, the tuition is about $35, and you can get signed up at swan-capital.com under the upcoming events tab. Now, while you're there, make sure you sign up for our weekly update so you can stay abreast of the market's conditions, and also like us on Facebook and follow us on Twitter. Now, I want to welcome our expert today, which is Shane Gordon from Cornerstone Mortgage. Thanks for coming on the show, Shane.
Thank you. Good afternoon, everybody.
Now, before we jump into all about reverse mortgages, I want to share with you the foundation of today's retirees. You know, I had an elder gentleman came to me after a workshop yesterday. He said, Andrew, not many people understand the situation that I am if you've not been in retirement. He said, right now I'm on the 1970 income, and it's 2013. You know, his Social Security is increasing a little bit with those cost of living adjustments, but a lot of his income was fixed. So as his expenses continue to increase, because we all know how gas prices and milk and everything we need continually increases, a lot of us live on that fixed income, and the gap just keeps on getting bigger and bigger. And a stat shows that only when you get to retirement, families are living on 57% of their income. And so that big drastic drop, and if you're on fixed income, that gap keeps on continually getting bigger. So I want to share with families about a really great tool that can help fill the gap. And Shane, will you start off and share with our listeners what Cornerstone Mortgage is, a little bit about your company and your background?
We are a local company. We've been around, I think this is our 10th year in business, and we do all types of mortgages. We help people with do regular mortgages, the government loans, FHA, VA, rural development, conventional loans. But also, we started, when I started with the company about 6 years ago, we launched into looking into doing reverse mortgages. And the reason was it was just a demographic reason, because the baby boomer generation in 2008, that was the first year they started turning 62.
Right.
And 62 is the minimum age to qualify for a reverse mortgage. So, and I think the statistic is every day in America, 8,000 people turn 62 years old.
Mm-hmm.
So we are a nation getting older.
Sure.
And as you know, if someone's retiring earlier, then they're going to have longer that they'll need income. And we had heard a lot of bad things about reverse mortgages. And it is what you said. It is said correctly that it is a controversial topic, because I do speak to groups in both Alabama and Florida. We're licensed to do mortgages in those two states. And a lot of times when I say the term reverse mortgages, they think I said a dirty word.
That's a bad word, yeah.
So that is exactly true. So we investigated the program because we had heard the same thing. So if what we heard were true, we wouldn't want to be involved with them, because the reason we're still in business, we weren't really involved with that subprime mortgage stuff, the stuff that really took a lot of companies under.
Right.
So
Tainted a lot of others.
Exactly. And we really wanted to keep our reputation good, so we investigated it and found that about 95% of the things that we heard were actually not true. So,
and that's true a lot of tools and investments out there. What I share with families are there's typically not a bad investment, or they want, the SEC or the insurance companies won't allow, to have those products out there. It's just a bad investment for you.
Right.
And you got to determine what your situation is, and does those investments or tools match up?
Right. Exactly. And that's what we, when we realized that this was a program that really could help people, that's when we started to talk to people about it. And, our main goal, and it's very much like Andrew, like you, is we just try to educate people on the correct information of how this program works. And after we tell them the truth about how it works and get all their questions answered, if it ends up being something that's not right for their situation, then that's fine, but at least they made the decision on correct information.
Sure. Make an informed decision.
Exactly. But a lot of people, when they've heard stuff about reverse mortgages from other people, and those people are just passing along. It's like the old game when you're a kid, and you sit in a circle. Okay, we're going to give you something to say, and then pass it around. By the end of it, it gets something totally different.
Exactly.
And that's what this is like. I mean,
and that's why we're going to talk about some common myths on the a little bit later in the show. Now, laying the foundation, Shane, this benefit. You talked about demographics in Pensacola. There's a lot of families, especially the greatest generation, believed in paying off your house, which is a fantastic goal. It's paying off that mortgage and not having any liabilities. And I'm a great fan of being out of debt. Now, there's a difference between being in debt and having debt. So a lot of families, what I see, and it's sad, they get into their 70s, 80s, and they're house rich and cash poor. They're sitting in this, great big house, and they have all this equity and equity doesn't earn anything. And they're not living life because they, spent down their other investments, and all they have left is their house. So a lot of times that's where a reverse mortgage can really come in. Now, share with us, when it was created, the reverse mortgage program.
The program has been around since 1989. So it is a federal program through the Federal Housing Administration, which we just commonly know as the FHA. The reason the program was created was really just like what you talked about. If people remember the late Senator Jack Kemp, he was one of the ones who spearheaded the program. And the thought was, for most people, if they've lived in their home a long time, then they've either paid down the mortgage where they have a lot of equity, or they've paid off the house. So for most of us, our house is our greatest asset. So this is a way to be able to access the money from that house and that your greatest asset, but do it in such a way that it's not creating a monthly burden, which most people that are retired, as you know, are on a fixed income. So if you were do a regular mortgage and take cash out of your house, and now you've got another monthly bill, and you've got to qualify for it with your income and credit. So this was the thought of being able to make it simple for someone with a lot of equity or that their house is paid for to turn that asset into something that would work for them, but not create a monthly burden.
Sure. Now, a lot of families have heard of reverse mortgages, and sometimes they think, it's just going to be one check to me, and it might not be a big enough check. But it's not always just a monthly check to you. There's multiple different ways you can, strategically different options you can use, right?
Exactly. The way the program works is if someone has an existing home, this is on their primary residence, this is where they live, we do an appraisal of the property, and the client qualifies for a percentage of the appraised value based on their age. Okay? So if they have an existing mortgage, we pay that off first. So that eliminates the mortgage payment, and whatever money's left over goes to them tax-free.
Now, you brought up age. Now, is that for their benefit or the insurance companies? Why do they do it by age?
Well, it's basically the program was set up to help retired people. So they have, as you know, being the expert on Social Security, that 62 is the first time you can start drawing Social Security.
Sure.
So they use that same pattern with this program. So 62, a lot of people are retiring at that age. So that's the minimum age to qualify for a reverse mortgage.
Okay. And as their age increases, and let's say we do it 70 versus 62, the payment or the line of credit will be more?
It is. And what we try to tell people, just get something in your head, the rule of thumb is if you take someone's age and subtract 10 from that, that's around the net percentage of the appraised value they qualify for. So if someone was 70, you take 10 from that, somewhere around 60% net of the appraised value, and obviously as you get older, that's going to be higher. If you're younger, it's going to be a little bit lower. But
that's a great rule of thumb.
Yeah, and that just kind of gives you an idea. And if you compare that to other ways where someone could access the equity in their home, option number one would be to sell the home, and they get 100% of whatever it's worth minus any.
But that's not
costs.
always liquid or an option.
Exactly, and then you've got to find another place to live. Option number two is to do a regular mortgage where you're taking cash out of your house. Even though the rules have tightened up, you can still go up to 85% of the value of the home, but you've got to qualify with your income, qualify with your credit, and make a monthly payment on a fixed income. So that doesn't always work. Option three is the reverse mortgage. It gives you the least amount of all of these three options, but with the benefit that you never have to pay it back as long as you live in the home. The only thing that you continue to pay is your property taxes and homeowner's insurance. So that's the reason why the concept was such to be able to turn that equity into something that would work for the client, either just eliminating the mortgage payment or taking tax-free income or a line of credit that they could access at any time when they need money, but do it in such a way that as long as the husband or the wife, if they're married, as long as they were at least 62 when they started the reverse mortgage, it will cover both of their lifetimes in that home.
Wow.
And they never have to pay it back.
And again, we don't know what the finish line is going to be for anybody. You know, when I talk about retirement planning, it would be nice to know when our last breath is, when the actual race ends. And you brought up a good point. It's joint. And definitely a lot of times women outlive men, which causes a planning nightmare. So that's good to know with reverse mortgages. Now, if you're just tuning in, we have Shane Gordon from Cornerstone Mortgage, and we're talking about a controversial topic, reverse mortgages. And we're going to talk about the pros and cons. But I want Shane to kind of lay out the process. You start talking about they look at your life expectancy, but continue with that.
Well, just the way the process works, what we do is we actually have a consultation with the client. We sit down and talk about what their situation is. We get just some very basic information. We get an estimate of the value of their home. We get the dates of birth of the person who's living in the home, as long as they're at least 62. And then we can run the scenarios based on that value and based on their date of birth, and that tells us what they qualify for. We'll need to know if they currently have a mortgage, they don't have a mortgage, and we sit down with them and just go through, explain everything, show all the documents and everything so they can see all the numbers in writing. And then just decide, what do they need? Is it just that I just want to get my mortgage paid off? Is it I'm living in my house and...
Well, let's stop at that one if you don't mind me. Again, a lot of people think when you get a reverse mortgage, they pay you. Well, let's say you don't have your house completely paid off and you're near retirement and you're saying, I just want to retire, but I need to work 5 more years because I got to pay my house off. A lot of people don't know that you can use a reverse mortgage just to stop monthly payments. So that was the first one you talked about.
That's exactly right. And and I would say the majority, in fact, I saw one of the biggest advocates these days of reverse mortgages is Fred Thompson.
Sure.
I saw his most recent ad yesterday. Actually attended the National Reverse Mortgage Convention in San Antonio last year, and Fred Thompson actually spoke. His own mom actually did a reverse mortgage in recent years before she passed away. But he was talking about that, one of the advantages of doing a reverse mortgage is that very thing. If you have the monthly reminder of why you should do a reverse mortgage, which is that monthly payment. So if your payment's $1,000 a month, and you would have to work 5 more years, let's say using your scenario, to continue to pay that, or do a reverse mortgage, eliminate it altogether, you can go ahead and start enjoying retirement now, or continue to work as long as you want to, and now sock that money away into some type of income-producing vehicle.
Sure.
Versus continuing to work to pay the mortgage. A lot of people that are still working in their 60s and 70s and even 80s are continuing to work just to pay the mortgage, and if they've got equity, they don't have to do that.
Right. So that's the first option, and you were going to the next options.
The second option of where you take the money is you set up a line of credit. The line of credit is based on what you qualify for. That line of credit actually grows over time as the home value grows, and then you interest only accrues on the amount that you actually take. So you can, if you had a line of credit set up for $100,000 and you needed $10,000 right now to fix up the house or pay off debt or whatever, you could take the $10,000. Interest only accrues on that amount. The unused portion, in this case 90, if the line of credit was 100, will continue to grow. Every month you get a statement showing that available line of credit has continued to grow over time.
Which is fantastic for some retirees because maybe their income and their expenses are met, and they think, with the cost of living adjustments, they'll balance out and they're okay on income, but they're worried about, let's say, in a big emergency expense, or they want to take a nice vacation. Well, that's a pot that they can pull from to enjoy their retirement or have the peace of mind that know they'll be okay in retirement. So the second one's the credit line.
That's right. And then the third is taking monthly income. And that would be, and that's when we really like partnering with a financial advisor like yourself, because we don't know all their financial picture a lot of times. But this is tax-free income. All the benefits of a reverse mortgage are tax-free. So we can actually do a calculation based on the amount they qualify for, and they can do a lifetime payout. So literally will cover them for the rest of their life. And that is, let's say for example, someone's 70. Now the way they're coming up with that calculation, they take their age out to age 100. Okay, so you can imagine that's going to divide that out pretty well. But if someone said, my life expectancy is more like 85, so I need more money now, then we could do that. We could do a 15-year calculation or a 10-year calculation. No matter what you do, if you don't take the lump sum up front, which is one of the options that people usually do if they do a mortgage, have a mortgage we're paying off, then you can change it at any time. So if you start out with monthly income and you find out you need to take all the money or switch to a line of credit, you can.
So it's not locked down. It's not like you can do a mulligan or a redo and say we want to switch it.
That's exactly right.
Wow, that's a lot of freedom out there. Now I want to move to, we talked about a lot of great things. I mean, if that sounds like you out there, this can fill the gap for a lot of retirees. Now, where does, reverse mortgages get the bad rap? Let's talk about the opposite side and play devil's advocate.
Well, the bad rap comes from two main myths that people think are true about reverse mortgages that are not really true. The first is people think that if you get a reverse mortgage, you don't really own your home anymore. In fact, and I'm sure,
and that scares a lot of seniors. You've worked your whole life to pay this off, and then someone's going to snatch it from you. That's scary.
About 4 years ago, the Wall Street Journal put out a story talking about how seniors were struggling in this economy. And they said one thing you can do is take out a reverse mortgage on your house. That's where the bank buys your house, lets you live there, and sends you a monthly check. Well, Andrew, that's not the way it works at all. Okay, we actually,
but they take the publications, and that's
the
gospel.
Wall Street Journal is nationwide. We actually emailed the reporter to explain to her, that's not the way it works at all. She said, I've already got some feedback on that. That's the way my editor wanted to write the story, and we're going to print a retraction. Well, where that retraction was printed. It was on section D, page 37.
Right, 2 centimeters by 2 centimeters.
Exactly, so no one actually saw that. So misinformation like that goes out nationwide. So the truth is, if you get a reverse mortgage, you still own your home. If you later on want to sell it, you could do that. If you want to refinance it again with a regular mortgage or with another reverse mortgage, you can do that as well. If you want to add a room onto your house, you don't have to ask anyone's permission. It's your house. You still own the home. So if someone currently has a mortgage, they know they own their house. All they have to do is make monthly payments. It's exactly the same thing when they get a reverse mortgage. They still have a mortgage on their house, but they're not required to make payments, but they still own it. So that's myth number one.
Fantastic.
Myth number two is probably we hear more often is the inability to leave the house to your heirs. That basically,
because that's their legacy. A lot of families, they say, I've lived in the house. My grandfather built this house, and this is the family heirloom that we want to pass down to our generations. And if we do a reverse mortgage, then it won't be ours anymore.
That's right. And that's a lot of people think that if you pass away, the government gets the house or the mortgage company who gave you the money gets the house, and that's simply not true. You can put the home in your will, and then the heirs will have up to 12 months after the clients pass away to decide what to do with the property. Now, during that 12-month period, they're not required to make payments. Interest will still accrue on the mortgage up until it's paid off, but they've got a year waiting period to figure out what to do. And the biggest thing is to find out what the value of the home is compared to what the balance owed is.
Sure.
So if there's equity there, if the house is worth more than what's owed, they could sell it, get the profit. They could refinance it if they want to keep it. If they had inheritance to pay it back, they could do that as well. They have up to 12 months to make that decision. But the good news about this program, really the great news about this program, is it also covers the worst-case scenario, which if you see the statistics, Andrew, that there are a third of all homeowners in America right now that have a mortgage currently owe more on their house than what it's currently worth. Okay?
Basically, they're upside down.
That's exactly right. So if that happened, if the clients lived long enough and now the balance was higher than what the value of the property was, one of the options that they would not going to be able to sell it in that case because they have to bring the difference to closing. They can't refinance it because it's upside down. If they didn't have the money to pay it back or didn't want to, here's what they do. They contact the mortgage company who originally gave mom and dad the money, let's say, or the FHA and say, look, we've inherited this property. Right now, let's just use a scenario that the balance on the reverse mortgage is $200,000, but the house is only worth $100,000. So here's what we want to do. We're going to turn the keys over to you. We're going to take out all the contents of the property, which is our inheritance, and the FHA would take the property. They would sell it in this scenario for the $100,000 market value, but we're saying the balance was $200,000. So in this scenario, the FHA will literally write a check to the mortgage company who originally gave them the money to cover that $100,000 difference. That's why the heirs are guaranteed they can never owe more on the property than what it's worth. So there's nothing negative about heirs inheriting a property with a reverse mortgage on it, because if there's equity there, they can take advantage of the equity. If there's not equity there, or if it's upside down, the FHA guarantees to pay the difference.
And this is such a perfect market to give an example of that, because many people are upside down. So this is the worst case.
Right.
Hopefully, real estate prices will continue to increase,
right.
But you're seeing the worst cases. And that's what he just explained is a great thing. It takes the liability off the family and transfers it to the companies that, they took that risk. So that's a fantastic.
And let me just explain one other thing about that. Just so people out there listening, just the difference between a regular mortgage and a reverse mortgage is this. On a regular mortgage, every time you make a payment, most of the time you've got something going to principal each month, something going to interest.
Right.
So every time you make a payment, the balance goes down a little bit every month. If you do a reverse mortgage, since you're never required to make a payment, you get to choose what the interest rate will be. Well, it's an adjustable rate or a fixed rate. But since you're not making payment, that just means the balance will be going up a little bit every month. So that's when I'm saying that the interest accruing, that's what I'm talking about. It's just working completely opposite from a regular mortgage, that the balance is growing over time, but you still have those same guarantees that you're not required to pay it back as long as you live in the home.
Well, fantastic. Now, Shane, we're going to take a brief break. But again, if you have a question about reverse mortgages and you want to get that answered right now, give us a call at 478-3116. That's 478-3116. We'll be right back.
What your money would say. Today's financial landscape can be rough. One of the most important aspects of planning is choosing the right guide to help you navigate the road to retirement. Andrew McNair and the team at SWAN-Capital is dedicated to providing the very best service in the retirement planning industry today. SWAN-Capital is a full-service independent wealth management firm dedicated to providing guaranteed custom income plans that you cannot outlive. Contact Andrew McNair at SWAN-Capital 850-380-9558. That's 850-380-9558. The difference between SWAN-Capital and you retire once. We help people retire every day. You should be enjoying your retirement years, not letting worry keep you up at night. SWAN-Capital. Sleep well at night. Contact Andrew McNair at SWAN-Capital 850-380-9558. That's 850-380-9558. Again, that's 850-380-9558.
The Veteran Benefit Project, founded by Andrew McNair, president of SWAN-Capital, is a nonprofit organization dedicated to helping veterans and widows of veterans with long-term care expenses by qualifying for the VA's Aid and Attendance Benefit. Learn how to receive over $24,000 per year from the VA towards long-term health care. There is absolutely no fee associated with our assistance to the veteran, the widow of a veteran, their families, or any retirement community. Our goal is to preserve the dignity of the veteran and to reduce the dependency on the Medicaid system. Again, learn how to receive over $24,000 per year from the VA. Contact the Veteran Benefit Project 850-380-5137. That's 850-380-5137. 850-380-5137. Look us up on the web, veteranbenefitproject.com. At the Veteran Benefit Project, we are committed to helping you secure the benefits you deserve.
Retirement expert Andrew McNair. Changing the retirement paradigm. Now back to what your money would say. Brought to you by SWAN-Capital.
Welcome back to What Your Money Would Say. If you're just tuning in, we have Shane Gordon from Cornerstone Mortgage, and we're talking about reverse mortgages, the pros and the cons. And we have a caller with a great question. Sue, welcome to What Your Money Would Say.
Yes, my question is, okay, it's great for the heirs, but suppose you would like to sell the house and go to a retirement home, but the mortgage is more than what the house is worth.
What a fantastic question. I'll let Shane take this one.
That's a great question, Sue. Basically, in that scenario, the same guarantees that the FHA provides are to the clients themselves as well as to the heirs. So in that scenario, if you had lived long enough in a house that the value of the house was now less than what the balance owed is, and you need to go into a retirement home, assisted living, nursing home, someone could sell that home, and the FHA will pay the difference if it's upside down as well. So I mean that you could walk away from that and still not be in a situation that you would be left upside down, because that guarantee the FHA provides is for you. Really, it really is for you as the client primarily, and then it's obviously a benefit to the heirs on top of that. But it covers both the life of the senior themselves as well as the heirs. So yeah, that would be something that you would have no problem with that, because we've had clients in that situation that depending on if
especially with the housing market, what it's done here.
Yeah,
absolutely.
And that's a great question.
Absolutely.
The liability, you don't want that to transfer to heirs. You want to have them have options. And so they have the options to, jangle the keys and hand them back to the mortgage company, or say, hey, we're going to refinance it and we know it's upside down, but at least we have options on taking the house back if we want it. So thanks for your question, Sue.
Thank you.
Okay, thank you for answering it. Thanks.
You're welcome.
Bye-bye.
Again, Sue has a great question. There's options here. A lot of times they think, when seniors get into a reverse mortgage, that they've signed away their house and now their equity is the bank's, and it's now not any options to their own. And that's not the case, is it, Shane?
No, it's not. And what's amazing about this program is pretty much any type of situation you can think of, we have worked with clients on it. We've had clients that if it wasn't for this program, they'd have lost their home. We've had many, many clients that just would love to get rid of the mortgage payment, be able to live a better life, like to have home health care maybe to turn the equity in the house into to be able to stay at home versus having to go to a retired facility. But what's amazing is many, many wealthy clients do this as well that are very business savvy. We had a client in Alabama this year, the house appraised over $1 million, house was paid for. He took the money out. He said, are you telling me that I can actually access the money in my home and never have to pay it back? Because he used the money to fund some of his business ventures. So it really is amazing that all the different types of situations, and every situation is different. It's not for everybody. It's all back to educating clients on how it works and then helping them decide if it's the right thing for them.
Right. And you said wealthy clients, the same thing. When you hear tax-free, that sounds pretty good, especially when you're in the higher tax brackets. You think I can get my equity back to me tax-free? It's always a great thing. And, again, he said a great point is it's not for everyone. It's just a tool. Now, tools are important, but it takes a strategy and a blueprint to actually build a solid financial plan. And that's why I always encourage families not to think about any decision as just one thing. Think about mortgages. Now I'm going to go think about investments. Now I'm going to go think about insurance. No, you think about it collectively, and you pull experts together like Shane and me together and say, does this make sense for my retirement plan? See, here's a prime example that strategy is so important. Let's say you have a lot of life insurance. Let's say you have $500,000 or $1 million of life insurance, and you owe $300,000 on your house. No, I apologize. You have $300,000 equity. You have it paid off, and it's worth $300,000. What that does is that gives you the ultimate permission slip. And let me explain what I mean by that. You have the permission slip to be able to spend down that equity tax-free, and don't worry about the heirs not inheriting the house or inheriting it upside down, because you know that you have life insurance that's going to come at your death to actually pay off that mortgage, and they get to have the options again to keep it or sell it. So wouldn't that be a nice option?
Absolutely.
So again, if we'll recap, it's not for everybody. And if you'll briefly just talk about the pros and the cons before we wrap up.
The pros are obviously being able to access the equity, not having to pay it back as long as you live in the home. The cons are the closing costs are higher than you'd see on a regular mortgage. So that's why we have to explain why that is, but they're all financed in.
Well, thanks again, Shane, for coming on the show, and we'll see you next time on What Your Money Would Say.